I'm always warning you about fantastic stocks of great companies that run up into earnings. When the expectations get ahead of themselves, those stocks tend to go right back down, even if the underlying company reports a good quarter. Look at ServiceNow, the cloud-based software company that helps businesses automate all sorts of back-office jobs. Stock sold off hard in after-hours trading because the company reported a quarter with a little bit of hair on it. And I mean a little. ServiceNow delivered an 8-cent earnings beat off a 63-cent basis, higher than expected sales, up 35% year-over-year. The problem, the company's subscription billings forecast for the next quarter was a bit light, as was its operating margin guidance. But because the stock had run into the quarter, anything less than perfection was going to cause a sell-off. And I question these nitpicks. So is it worth buying into the pullback? Let's take a closer look with John Donahoe. And John's the president and CEO of ServiceNow. Get a better read on the quarter of the company's prospects. Mr. Donahoe, welcome back to Mad Money.
Thank you, Jim. Nice to be here.
All right, John, a lot of times these analysts get caught up in nitty-gritty, and I find that they may lead you in what I call a misdirection play. Let's talk about the things first that I think are very important. New customers and big customers. Sign any, and how big?
Well, we now, Jim, have 766 customers that are $1 million and greater. We signed 40 new customers of $1 million and greater in the quarter. And that's just symptomatic of the fact that we now work with 75% of the Global 500. We're increasingly a strategic partner with those customers. 17 of our top 20 deals had 3 or more products. And so we feel very good about the relationships we're building with the world's largest customers, our largest companies and governments.
In the time since I've known you, you've built up quite a relationship with Microsoft. I think Microsoft has had the single best quarter of any large capitalization stock during this year. Tell me about the relationship and what it's doing for ServiceNow.
Well, the relationship, Jim, is a very good one. And we're initially focusing on U.S. federal business, where Microsoft has a strong presence, as do we. We have a huge federal business, and our data centers have a certain security clearance. Microsoft Azure has the highest security clearance. So rather than us trying to replicate that, we're going to partner with them to take advantage of that Azure capability and jointly call on U.S. federal customers, as well doing the same with federal customers in Australia. And increasingly, we'll look at other government markets. So we have 20 different product integrations with Microsoft, a long history with them, so we think there's a lot of shared opportunity together.
Okay, now there was some complication in the call people were trying to figure out, but you also had a departing CFO everybody loves. There was a lot of congratulations to him, which is totally right. But people seem to pick on different metrics, and I have learned from someone whose metric, frankly, you did better on than he did, from Mark Benioff from Salesforce, that I need to get up to speed about remaining performance obligation, because that is really the apples to apples tell, not necessarily bookings, not necessarily billings, but RPOs. How do you stack up versus what you were looking for and versus other cloud kings, as we call them in your industry?
Well, our RPO, we do think RPO is a very good indication, probably the best forward-looking indication of our business, because it demonstrates what kind of revenue you can expect going forward. Our RPO, our current RPO, grew 35% in the quarter. So we feel very good about the outlook and future of our business. And we raised guidance for the full year, both on revenue and billings. So we see a lot of opportunity, and we have a lot of strong momentum, and we're focused on building those customer relationships that drive that growth.
Okay, I know that there are legitimate issues about, and your departing CFO talked about it, about some cell phone renewals shifting from Q2 to Q3. The largest was this a federal customer. One of the reasons I wanted to bring up Microsoft is that sounds like that might be part of that nexus. I don't think I should read weakness in your business into that statement.
Not at all, Jim. That in particular case, and again, the reason it impacted things was government are self-hosted, and with Regulation 606, Accounting Regulation 606, it's how it's accounted for. That particular case was a large federal agency that is expanding our relationship and pushed the renewal into Q3. We're highly confident it will close, and we have a tremendous federal backlog in Q3 in pipeline. And so we feel very good, which was reflected in our annual guidance, raising our annual guidance. We can't control what happens in one quarter versus another, down to the nit. And overall, we feel very good about our annual guidance and raised it, and we feel very good about our business.
All right, again, I want to clarify something that an analyst asked on the call then. One analyst said it looks like the full-year increase was less than what we saw at Q2, sort of an implicit guide down for the second half. That's not really the case, is it?
No, Mike answered that question 3 times on the earnings call, Jim. What basically happens there is certain renewals got pulled into Q2, so that was reflected into the Q2 billings, and therefore it doesn't change our full year billings guidance, but it counts for it earlier in the year. So we actually raised billings guidance for the year $5 million, which just reflects the fact that we are increasingly and continue to be very optimistic in our business.
Oh, I'm so glad you said that because, I read this thing over and over. I said, come on. But that's their job. I'm more interested in things like your mobile app and how people love that at the workplace. And that's what they're asking for. That's what I want to know about things like innovation that you're doing.
Well, our customers, I spend so much time with our customers, and our customers are very excited about mobile coming to the enterprise. It's been a long time in coming. Our release in Q3 will have native, out-of-the-box, consumer-grade mobile capabilities. So now any ServiceNow customer can have a brilliant mobile onboarding app so that their new employees can get up to speed quickly, seamlessly. You can show a young new employee, a millennial, that you, in fact, are a modern company that helps get them on board and productive quickly. Also, the Now mobile app, which will allow employees to get their questions answered, problems reported and dealt with, get information like all my approvals are now in one place every morning. I can check them. And so we're very excited about the mobile capabilities coming in Q3, native out of the box, so every one of our customers can build them in a low-code, no-code way.
Well, that is what's going to drive
Mobile's coming
things.
to the enterprise, finally.
And that's what's going to drive things. And I do have to tell you, John, you have been just so frank with us. And I wish I hadn't had to get in the weeds on something I knew wasn't right. But it's a great opportunity for people who watch our show to say, I don't know why that stock's down. I just heard John say that things are good. Isn't that the real takeaway?
We feel very good about our growth. We feel very good about our customers, very good about our prospects, and we're just focusing and executing so our customers get those great experiences.
That's all I need to know. Thank you to John Donahoe. He's the president and CEO of ServiceNow with another great quarter. NOW. Thanks so much, sir. Stick with Cramer.
Don't miss a second of Mad Money. Follow @JimCramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.